Hello, my name is Rachel Vahey, and I'm a Senior Technical Consultant here at AJ Bell. The subject for this webinar is the advice given on defined benefit transfers. Now, this remains one of the most talked about areas of pensions, and it continues to be under the spotlight. The market and the business area just keeps on evolving, and it has been the subject of intense scrutiny by government and regulators. This is a refresher session, and it's to remind you the key points to bear in mind when you are developing or reviewing your processes in this area. So the FCA's focus on this particular area, advice given on defined benefit transfers, is not going away. They are still intensely scrutinising what the advice is given, how that matches up to their expectations. And we can expect this to continue. Let's look at the defined benefit transfer market. Now, there are reports that the number of defined benefit transfers is falling, and that has now fallen to a 5-year low. There's probably a few reasons behind that fall. A lot of it is to do with the lack of supply and advice is pulling out of this particular market. Now, this could be down to the FCA introducing a new way of working, and this came into effect last October in 2020. There's lots of guidance out there about what the FCA expects advisors to do and how they operate in this market. And some advisors might have felt that it really just wasn't worth their while anymore doing this. There is also now a ban on contingent charging. And that also may mean that some advisors decided that their business model just didn't work anymore for this particular market and pulled out. Whatever, this still remains a key focus for the FCA and government and politicians and media as well. So as I said, contingent charging has been banned from October. This means that advisors have to charge the same amount of money for the initial transfer fee, whether or not the transfer goes ahead and whether or not they recommend the transfer. Advisors can still charge ongoing management fees if the client transfers, but if they choose to do that, then they have to make sure that the ongoing management fees are the same that they would charge for other clients with a similar amount of money. Now, freedom of information request has been made of the FCA, and they have recently given some information on contingent charging models. As you can see from the slide, this information was gathered between October 2018 and March 2020. Where a contingent charging model was used, the conversion rate was 68%. Where it was a non-contingent charging model, the conversion rate was only 28%. Now, no doubt this is part of the key evidence which led the FCA to ban contingent charging. In this webinar, I'm going to pull out some areas that you may want to consider when you are developing or reviewing your processes for giving advice on defined benefit transfers. There are two things to look at here. The policy statement, which was issued last June, sets up the framework of how the FCA expects the defined benefit transfer advice to be given, and it looks at the whole process from start to end. How you need to prepare as a firm for this business, how you initially talk to clients, how you give your advice, and also looking at ongoing management. The guidance, which was finalised in March, only a few months ago, hangs off this framework, but it really brings it to life. It gives examples of how to work in this area. So the guidance aims to support the development of good practice and processes within firms. It really tells you what sort of areas you need to be looking at when you're developing or reviewing your processes. It gives you loads of good examples of good practice and contrasts that with bad practice. Bringing in the FCA's experience, they're often quoting cases or files that they have seen or they have reviewed over the last few years. So this is absolutely an essential read for you. So let's start by looking at a few things that the advice firm has to do before they even start the process of talking to clients. I'm going to look at a few key areas that the guidance and the policy statement brings out. Now, the FCA is concerned that firms are not holding adequate PI cover. And if they don't, then it's a simple message. The FCA expects you to stop business immediately. If you are offered PI that contains exclusions or limitations, then you need to consider if these unreasonably limit that cover. The FCA is remarkably quiet on the supply side of PI, as we know that this is a tricky market at the moment and costs have risen quite substantially. But the FCA isn't really coming out with any silver bullet on this area. And it's almost expecting the market just to right itself. The FCA expects you to have good systems, controls, and records. It wants you to detail exactly what you're going to do, how you're going to do it, and then it wants you to detail what you have done. But it doesn't stop there. The FCA is also expecting you to monitor what you've done and use management information, good MI, to pick out risks. They want you to look at things like conversion rates or how many insistent customers you have. And all of this information has to be accessible to the FCA when they walk through the door, because the first thing they're going to start looking at are your records on files. The FCA wants you to have a good training and competence scheme. There's a new requirement in that a PTS, a pension transfer specialist, has to undertake additional 15 hours each year on DB transfer advice, on training. And that includes 5 hours from an external source. And hopefully this webinar today could count towards one of those 5 hours. You've also got to be very aware of your financial promotions. So even things that you are doing before you actually speak to a client, you've got to review your communications to make sure that they're balanced and they're not misleading, that you're talking about both sides of giving of the transfer equation, whether you're looking at whether people should stay and the benefits or whether people should transfer and the benefits. So again, very balanced, but looking at all elements of your practice. And working with introducers is an area, remains an area of high risk as far as the FCA is concerned. They're not saying you can't do this, but what they are saying is that you need clear processes to know who does what, and also that the client is very clear on who does what and where the areas of responsibility lie. So once you have done that preparation as your firm, the next area is to look at the initial client contact. Let's start off by having a look at fees. The FCA is very clear that you must disclose your charges for both the transfer advice, but also ongoing investment advice. And you must do this before you give any advice. The client must know exactly what these are when they walk into the office. As I said before, there's no contingent charging unless they fall into one of the exceptions. Now, there's a couple of carve-outs from contingent charging, and I'm going to cover that later on in the webinar. You have to give the same level of, or you have to charge rather, the same level of fee for investment advice, whether the money is coming from a transfer or whether the money is coming from a different type of source. So if you have a client who has the same amount of money through an inheritance or something like that, then you should be charging the same amount. The FCA is worried that some people might try to backload the investment charges and to try and circumvent the rules that particular way. You need to be very clear about your business model and whether you are going to operate and whether you will arrange a transfer for an insistent customer. Now, that completely depends upon you and the approach that your firm wants to take. You might decide that you only want to work with existing clients who you know and who understand you, and where there is a level of trust on both sides. Or you might decide that you're open to working with anybody, even if you've never had them as a client before or never met them as a client before. But you need to be very clear about what you are comfortable with doing. You need to say whether you are going to offer abridged advice or whether you will only offer full advice. And as I said, you have to make sure that you disclose all of these charges before giving advice, and you have to make sure that the charges that you disclose for the defined benefit transfer advice are personalised. They are relevant to the client. So let me show you an example of how this could work in practice. This is an example which I've taken from the FCA guidance. And as you can see, it outlines a few key details. Let me pick some of those out. So first of all, you've got to use the transfer value. And if you don't have the transfer value, the finalised one, which is probable at this particular stage, you've got to use the best estimate that you have, the most recent estimate you can get from the client. So looking there, it's pulling out that it's a transfer value of 400,000. You've got to show the cost and the fee for the transfer advice. And you've got to do that both with a percentage and a monetary term. And this is just because the FCA feels that some clients may get confused by percentage terms. And obviously 1% feels a little bit lower than £4,000. So they want you to just pull that out. You also have to show the ongoing advice cost and the investment management cost. And as I said before, this just has to be the same as you would offer to any other client. And you have to be very clear with your client that they have to pay the initial advice charge, whether or not the transfer goes ahead or whether or not you recommend the transfer goes ahead. They have to pay that amount regardless. And this has to be really upfront and very, very clear for the client to understand. One other area is triage. And this is again covered within the FCA policy statement and the policy guidance. Now, triage is when you start initially talking to the client, then you are able, if you want to, give them standardized guidance which can help them to decide whether or not to take an advice. It's sort of like an initial conversation. Now, this has to be done in generic terms. It can't be personal to the client in any way whatsoever. You could cover the workings and the features of both the defined benefit and the defined contribution scheme. You could cover how risks and benefits compare. You could discuss the transfer process, but you can't give anything which is a personal element to it. Now, you don't have to do triage. You don't have to give clients a triage service. You can choose to do so if you want. You could decide to outsource it, and there are a few companies out there who would be quite helpful and quite willing to do that. Your introductory meeting can't overstep this boundary either. So even if it's an initial meeting and it's not triage, it's not formally triage, it's just sitting down and talking to somebody, then the FCA is saying just be very careful, don't overstep this boundary. You might want to give your clients a document or maybe a web-based educational tool rather than sitting down and discussing these elements with them. I think if you're face-to-face with somebody, it's easier to slip into the personal, isn't it? Because the client is asking you questions back. And I think if you just give it more of a broadcast information, more telling them what the situation is, what the state is, then that might be easier to make sure that you keep on the right side of this boundary and that it's just generic information that you're giving. So the FCA says that any triage service and any information given at the triage service has to be balanced. You have to give information on both defined benefit and defined contribution plans. You can't just emphasize one side of the equation. It's got to be unbiased. You can't put any disproportionate focus on any specific area of defined benefit or defined contribution. You're just giving the facts how they are. It's got to be factual, but you can't comment on the value of information either. And it's got to be generic. You can't include any personal information there. You can't relate it back to the client's circumstances. I think Triage is a very useful service as a scene setter, but the client might feel frustrated after it because they're not entirely sure what it means for them. But that's where the next steps in the advice process come in. The FCA has lined out in the guidance some do's and don'ts concerned with giving triage. So it is quite interesting information. So the do's include saying what the pros and cons of each type of scheme is. They say, look at what sort of customer is going to benefit. Include the statement that we all start off with, that it's not in the client's best interest to transfer. And that's where any advice that you're going to give is going to start from. And as I said before, it's explaining the process about exactly how it works and what abridged advice is, if you offer that, what full advice is, and what the client can expect. And maybe also going through circumstances when you will decline the business. The FCA also give a list of don'ts. Now, this is, as I say, a non-exhaustive list of examples. So I wouldn't say this is the be-all and end-all. And the FCA is really taking quite a keen look at this particular area. But what they're looking at is information on the type of customer that would benefit from remaining, failing to say what type of customer would benefit from remaining, but maybe saying who would benefit from transferring. It's suggesting that a different type of death benefit is going to be preferable to somebody when you can't maybe say that because you don't know the full situation. It's exaggerating the situation if somebody falls into the PPF and maybe saying that, presenting it as the worst possible outcome, and maybe just not in a very balanced or appropriate way. Indicating whether somebody is going to be more or less likely to benefit from transfer. You can't do that. You can only set out the generic details. You can't say, I think in your situation, you might be best going to abridged advice. We might have a case, you might have a case here for us to fully explore. And also, if you're looking at modeling tools, then you've got to make sure that it's just illustrative values that you're using, and you're not using anything that is personalized. Going on to the next area is information gathering and abridged advice. Now, getting to know your client is the crux of the FCA's guidance. This is the absolute essential center point of it. The information that you gather has to be personal and it has to be complete. And it can only be that if the advisor firm is asking the right type of questions, and enough questions as well, deep enough questions and many questions. The bottom line here is that you have to have the necessary information to be able to assess suitability. And the FCA is really clear in the guidance on this. If you don't have all of the information, then you are unable to make a recommendation because it will not comply with the suitability requirements. So it's worthwhile as a firm spending time on this particular area to make sure that you're getting the right type of information, to making sure that your processes are wide enough and robust enough, and you're going deep enough. You can't ask superficial questions. You need to pry and prize open this and get a lot more information out from the customer. You need to make sure that there's no material gaps. The FCA says it's good practice to ask open questions, which I'm sure you would do, saying, why would you choose this action? Or Why do you want to do this, or what is important to you? But it's also essential that you get the hard facts and the soft facts as well. So you need to know things like age and occupation and things like that, but also soft facts like how do you feel about guarantees, or how would you react if the stock market crashed? Now, there is a list there of other questions, of areas that the FCA want you to consider. So on the right-hand side of the slide, so personal and family circumstances, health, finance, assets, knowledge and experience. All of these areas are expecting you to collect information on. You've got to look at things like income and expenditure. And they're not just looking at what's happening here and now. The FCA expect you to collect information on anticipated changes up to retirement date and probably beyond as well. So, for example, are there any children? Are they about to get married? Are you going to help? Is the customer going to help fund the purchase of a child's home? Are there any other really big expenses coming through? All of those elements. So it's not just going through how much they're spending today, it's also looking at how much they're spending tomorrow. The FCA wants you to test and to look at the knowledge and experience of what the customer has. So what other types of investments have they had? Have they had to manage it themselves? Have they chosen for other people to manage it? Are they comfortable with other people managing it? Now, customers don't have any experience of giving up a defined benefit scheme. You're probably only going to do one, maybe two defined benefit transfers in your life. So the FCA are keen that within this collection of information, you test whether your clients understand the value of what they're giving up and the risks that they're going to have to accept. Do your clients understand the way that the stock markets work? Do they understand fluctuating markets? Do they understand what could happen and what action they could happen and what action they could take? Keep full records. Now, I know this sounds such an obvious statement, but this is really what the FCA is going to want to look at. They're going to come into your firm, into your office, and that's what they're going to look at. They want to look at exactly what you have put down for each particular client. And they're expecting to see a lot of detail in this. Every update we receive from the FCA says a certain proportion of transfers, it's unclear whether the advice was suitable or not, or there were gaps in the records, there were information gaps. And that's because firms are not collecting the right depth of information. This is going to turn out to be a thesis on your client. Good news for your client, but you are really going to have to note down absolutely everything. Now, this is probably easier to figure out if we can look at a few examples. Now, I hope you can read this, but it'll give you the essence of the information. Now, if you're looking at collecting personal information from someone, this is an example of poor practice, where the advisor firm has just said what their age is, 52, their occupation, are they married, how many children have they got, how many are still dependent, what is their health average, where's the parent's status, alive, so there could possibly be inheritance. Now, they're looking for a lot more information than that. So on the other side, on the right-hand side, is an example of good practice. They're saying, yes, this person is 52, this is what their occupation is, this is where they started from. They started as a car mechanic, and then they come through to a quality controller. So they're showing the progression of this person's career. They're saying how many years that they've been married, and they're also saying what the spouse is called, what the spouse does for a living, and they should really put down the spouse's age as well. Yes, there's 4 children, but they're giving ages for the children. They're saying what they do, whether they're financially dependent or not. So, for example, some of them, the 2 younger ones, are just about to go into, well, one of them is just about to go into university. So that's going to be a big cost for them. So that's part and parcel of gathering this sort of information to be able to feed through to your analysis later on. Health average doesn't really tell you an awful lot. So again, it's putting some flesh on the bones of this and explaining why, some more details about that. Let's have a look at a couple more examples. The FCA wants you to make sure that you get the whole of a person's wealth. You don't just look at the pension scheme, which I'm sure you wouldn't. So they're looking at other financial assets, joint assets, property, inheritance. And again, it's you putting down and collecting as much information as you can on these particular areas. So an example of a poor practice is to say, well, they've got a few other pension schemes, but we didn't really get any details on this. And his wife, she's also got some pensions from her current and previous job. Both expect them to have a state pension, but we've got nothing on file for that. Instead, what they're looking for is a lot more information. They're saying, right, we need valuations on these particular schemes if they've got other schemes. They want to know how many previous workplace pension schemes they've got as well, because that's going to feed into your analysis later. And I'll pick up that point later on as well. They want to know what the expected income from these particular schemes are going to be. How many schemes does the wife or husband have, or partner? What other investments do they have? Do they have ISAs? Do they have investment bonds? Do they have another property? For state pensions, really looking to see a state pension forecast on file, and also to say whether they're getting a full state pension or whether there are any gaps, or whether they're going to look at funding those particular gaps as well. And then looking maybe at possible inheritances and looking at other debt. So you can see it's much, much fuller. It paints a much better picture of the situation for these particular clients. The FCA, as part of the gathering information, they want you to help assess the attitude to risk. Now, there's two big areas of assessing attitude to risk. There is the attitude to transfer risk and the attitude to investment risk. Now, attitude to transfer risk is a distinct area, and the FCA wants you to treat it as such. They want you to ask fair but not misleading questions. They want to find out how somebody approaches transfer and how they feel about the transfer. And it's got to be personal. What you're doing is you're assessing somebody's behavioural and emotional response to a transfer. So we're probably going quite far away from facts and figures here. We're looking more how people feel about the transfer. What's their attitude to giving up a safe return? What's their attitude to managing their own money? And I think it's difficult to do this maybe with standard risk profile questionnaires, possibly because a lot of them only ever really look at investment risk and don't look at transfer risk. So I think it's, as a firm, you're going to be wanting to develop how you ask questions around this particular area and how you tease out how comfortable somebody is with the whole element of transfer. And as part of that, you're going to be reviewing if they're best suited to a safeguarded benefit or to a flexible benefit scheme. So, for example, if you are trying to find out if a client would be likely to access the funds in a personal pension or a SIP in an unplanned way, so you're trying to figure out how they're going to, what sort of approach are they going to take to the SIP? Are they going to just dip in and dip out and things like that? You could ask questions about their current spending patterns and how the clients manage their money currently and how they plan for major expenditure and how they manage their debt or whether they do impulse buys. And that will give you an idea of how they would approach this big pot of SIP money. Understandably, the FCA wants you to look at the investment risk and the attitude to investment risk, but this is different to maybe other clients because you're looking at it in the context of defined benefit transfer advice. And it's important to put it within that context. Capacity for loss, the FCA defines this as the customer's ability to absorb falls in the value of their investment relative to certain outcome from the defined benefit scheme or known loss if the scheme goes into PPF. So they want you to contrast this with what happens within the defined benefit scheme or the PPF. They also say that you can use this assessment to explain how an unrecoverable fall in asset value may affect the income that a client can take and the effects on their lifestyle. So again, it's maybe investigating this and pricing this, but as a way of educating clients just to find out how they actually feel if their money did go down substantially within the first few years, what the effect of that would be, how would they feel about it, how could they cope with it. The FCA also wants us to look at objectives and needs, and this is quite a big area within the guidance. They want you to understand your client's essential income needs and how the defined benefit pension meets these, and that's compared to all the other assets that they have, and why those and how those assets can also meet the income needs as well. And they also want you to assess how a transfer can mean a shortfall or an increase in income. They want you to understand your client's objectives and to understand their priorities and their plans, and also what motivates them. They want you to challenge any false expectations. For example, the client could say, well, the PPF will leave me with nothing. I'll get nothing. You know, the employer looks like he's going to go to the wall, the scheme's going to fall into the PPF, I'm going to be left with absolutely nothing. But if I transfer, I'm going to get a 6% yield. So what you're going to be doing is maybe challenging this. Don't let those just go by and note them down. You're going to have to maybe use this as more as a two-way thing to challenge what the client believes about the PPF and put them right on that, and also to say like the 6% yield maybe after charges, but it's not guaranteed and you could get less than that. So it's really more of a two-way thing. It's almost part of the advice process in a way that you're starting to educate them about certain aspects. And look at the client's needs, split it up into essential, lifestyle, and discretionary, and challenge what they say they need. Explore what the additional expenditure is for. Ask them things like, how likely is it that you're going to pay off debt? How do you expect to pay off debt? What other expenditure are you going to have? What are your plans for carrying on working, and things like that. So start to explore all of those elements. I think the bottom line with all of this is it's unlikely that a tick box questionnaire is going to achieve this. Even if it's a very clever tick box questionnaire, you have to make this client specific and personal. Right, let me give you a couple of examples of how this could work. Again, what I've done is picked out some good and poor example practices from the FCA guidance. So avoid questions like, would you like to retire early? Do you want flexibility? Would you like to try and increase your pension income? I think the answer to all of those is a resounding yes. I mean, who wouldn't want to retire early? This sounds great. So I think it's maybe bringing that out broader. So, and maybe putting in some education there as well. So things like, if you do retire early, is it important for you to do this, even though it could mean that you run out of money later on? So again, it's almost bringing out the consequences and the implications there as well. Why do you want to draw out higher amounts of income in the early years of retirement? So not just say the client would like to take out £40,000 in the first 10 years, falling to £20,000 thereafter. You can't say statements like that. The FCA want you to say exactly why, and they want you to match up exactly what those income needs are. They also want you to balance your needs and objectives, and to make sure that you are, and you're, as I said before, you're challenging what these needs and objectives are. So they want to the client wants to know what they want to do in retirement, but they do not understand the level of income they require to meet their essential needs. So this is something, again, where the firm can help to explain what the current expenditure is and to help them understand exactly what they need going forward. You may decide to offer abridged advice. Now, abridged advice is just a short form advice process. It's been brought in from October last year, and it can only come out with one of two answers. So it can either say, I'm going to give you a personal recommendation not to transfer, or it could say to the client, your situation is unclear and you can continue to full advice if you want to do so. You cannot say, I've given you abridged advice, we've been through that process, I recommend you transfer. That's not the answer. You can only say you can go on to full advice. The idea is it's shorter, it's cheaper than full advice, and it should give the client to avoid if the client doesn't want to pay for a full advice process. If they do pay for abridged advice, then you must offset that cost against the full advice fee. And as I said, you've got to go to full advice if it's unclear to be able to actually do the transfer and to implement the transfer. You don't have to offer abridged advice. Some advisors have chosen to do so, some haven't. But if you do it, then it must be carried out or checked by a pension transfer specialist. The FCA says it's going to be useful, but it's not appropriate. It may not be appropriate for everyone, and the client may want all of the options, and therefore you really maybe just cut it out and just go straight to full advice. You can use an estimated transfer value, which might be useful because obviously you're always against the clock and run the risk of running out of the guarantee period for the transfer value. So you can use an estimated transfer value if you want. If you do that, then if you proceed to full advice, you're going to have to review the abridged advice using the guaranteed transfer value just to check that it's still valid, and then give the client an opportunity to review the decision to go to full advice. So it's almost like just putting in another little check and going back to abridged advice Mark 2. You shouldn't make any projections based on the transfer value if you use an estimated one, though this type of modelling is going to be part of the APTA, so it can't be used when you're giving abridged advice. And if you do give a personal recommendation to transfer, you need to have a suitability report as well. You've got to have that particular angle there. You cannot be an insistent customer until you have been through full advice. So if the customer then looks at it and goes, and you say, my personal recommendation is that you don't transfer, they can't then say, well, I'm just going to do that any road. You can't treat them then as an insistent transfer. They can only be one of those if they've actually been through the full advice process. Now, I mentioned earlier that contingent charging has now been banned, but it hasn't been banned in full. The FCA were very aware that there were some sets of vulnerable customers who could actually benefit from contingent charging, but they were very keen that they had to have certain identifiable circumstances. So these people could benefit from a transfer, but they may not have the means to really pay for advice. So these carve-outs can continue. But the FCA fully expects to see cases that the starting point is that the advice it's in the client's best interest not to transfer, even though they might have some personal circumstances. It doesn't matter. They're still expecting that to be the starting place, and it doesn't mean that the transfer is automatically suitable. You've got to charge the same as other customers, so you can't charge any less. It's just that the money might be taken in a different way. So you've got to make sure that it's the same for any other transfer customer. And you can offer some free advice, but it's really exceptional circumstances. So really go back to the COBS rules, the handbook rules, and also the guidance to make sure exactly when those are. So the two carve-outs are those people who are in serious ill health and those in financial difficulty. And this means that the client doesn't have to pay for the transfer fee out of their doesn't have to pay for funds for advice if the transfer doesn't go ahead. So the person to fall into a carve-out for serious ill health, their life expectancy has to be below age 75. Now, the FCA dilly-dallied around this particular subject for some time, because how do you actually know what someone's life expectancy is? They decided in the end not to ask a medical practitioner to say this or to evidence this, and instead people can self-evidence their own ill health. But if that's the case, then maybe you've got to think about how that works for your particular firm and make sure your processes on this are really watertight, because in a way it's now falling onto maybe the advisor to say whether somebody's life expectancy is up to 75 or not, and you are a financial advisor, you're not a GP. The serious financial difficulty criteria, I think, is a little bit more robust and a little bit more straightforward. There's no prescribed threshold or definition, and this gives you a little bit more flexibility to be able to set this out. And the guidance, again, is really useful in this area. What you're looking at is if you had to pay for advice, is there a heavy burden to keep up with domestic bills? Have they missed payments in any 3 or more of the last 6 months? That's the sort of things you're looking to indicate whether someone is in financial difficulty. Is the person really struggling? Would the person be really struggling to meet their essential bills? Now, FCA expects firms to have a really clear policy on this, on how to apply the carve-out. And it's certainly going to be an area that they're going to look at. So it's really worth just maybe taking a step back, and if you are going to do this, to make sure that you really set it out very clearly and very well. Okay, so the next section is to look at the full advice process. And we're going to start off by looking at the transfer value comparator, the TVC. And the guidebook and the handbook, guidance and handbook, tells you how to do a transfer value comparator, tells you the assumptions to use, which are laid out by the FCA, tells you what you are comparing. And what you're doing is you're looking at the cost of buying the DB scheme benefits in a DC scheme. Now, I know from speaking with advisors that there is quite a bit of pushback on this. You may not think the assumptions are appropriate, you may not think they work, you may think it's just completely irrelevant because the client doesn't want to buy an annuity. That's the whole point. They don't want that particular product. But that, in a way, is almost beside the point. That's not what the FCA wants. They want you to put the transfer value comparator as part of the analysis process. They want you to explain to the client how it works. They want your explanation to be balanced and to be not misleading. They don't want you to say, ignore this bit really because it doesn't apply to you because you're never going to buy an annuity, and I think some of the assumptions are a little bit dodgy. They don't want any of that. They want you to make sure that you spell out exactly what this TVC is showing and what it's showing in black and white, and what it's showing in very clear, defined figures. The other part of the analysis is the APTA, the Appropriate Pension Transfer Analysis. Now, again, this is the research and the analysis, and which you're going to use, and it's to determine the suitable course of action. Now, this is where the information gathering is going to come in, because the information gathering that you have done, all those particular areas, you are going to use that as the absolute foundation, the basis point for your advice and whether you think it's suitable for the transfer to go ahead. The FCA makes sure that says it has to go on personal circumstances. So you can't say, for example, I don't think all people from one particular scheme should transfer. You can't say that. You've got to base it on each person's individual circumstances, their knowledge, their experience, their attitude to transfer, their attitude to risk. you can't either set some generic conditions to be met. For example, the FCA brings on an example where they said, well, one firm said, as long as you meet this, at least the transfer is worth, start that again, as long as the transfer is worth at least a specific multiple of income, and the client has a certain attitude to investment risk, if those two conditions are met, so it goes over one particular boundary or over another one, we're just going to say transfers can go ahead. And the FCA has gone, no, you've got to bring this again back to the personal. Don't use standard paragraphs. Make sure this is individual. They also want you to have a look at alternatives to transfers and to give a summary of those alternatives and what the pros and cons are. For example, an enhanced annuity. Why not buy an enhanced annuity or compare that with drawdown? Or instead of death benefits, maybe look at decreasing term insurance quotes and again, compare that with drawdown. So they want you to look at all of those particular areas. You can use software packages, but keep it personal. Try not to just do a cut and paste model. I'm going to pick out a few areas that the FCA has looked at with regards to the APTA. So first of all, cash flow modelling. Now, I think the FCA is looking for this really, but they don't actually go as far as to mandate it. But it's certainly an area they want you to have a look at. They want you to go beyond average life expectancy. I think really up to age 100 is really what they want you to look at. And they want you to keep it personal. So don't just say a 4% income withdrawal from 65 to 100. They're not looking for that. They want it to relate back to the client. So looking at the specifics of what your client is going to spend and when they're going to spend, also meshing in when all the income from their different assets are going to start at different ages, and to meet the essential and the lifestyle needs that they have as well. And obviously with this, you're going to want to look at when certain incomes start. This is all going into that particular area. If you're looking at transferring to a SIP, then you might want to leave the pension income till some time later and keep it wrapped up in a pension as from inheritance tax as long as you can. For scheme solvency, they say if the scheme is in deficit, that isn't necessarily a reason to transfer. It's going to come into a mix, but it's not going to be the essential reason to transfer. And don't misrepresent the PPF benefits. It might not be the absolute end of the world if the scheme falls into the PPF. It really just depends upon the level of benefits that the person has, how likely it's going to happen. Again, relate it back to the individual. Don't overemphasize flexibility in death benefits. So don't just say better death benefits. Have a look at it and compare the priority to the client's other objectives, how they could trade off with other needs and objectives, particularly income. It could be that they prefer a higher level of income throughout their life than the death benefits. Look at alternatives and how they could fund the alternatives. One example within the guidance was one suitability report said the biggest advantage for this client to transfer is flexibility for death benefits. But then it completely ignored the fact that the cash flow modelling showed that the fund ran out at the age of 74 based on the client's level of income drawdown. So it's really the same, put it into perspective. Early retirement again isn't necessarily a reason to transfer. Have a look at what the scheme offers, what the factors are if the person stays within the defined benefit scheme. And also be realistic. If the person wants to transfer, wants to take early retirement at 58, you might want to go back and say, really, honestly, you're going to run out of a pension fund by this particular age, or you simply just do not have the right amount of money to keep meeting your essential needs and your lifestyle needs if you take this action. So maybe go back and challenge what they're saying. The FCA says advisors aren't order takers. Have a look at the pension commencement lump sum. If someone says they really do need that cash, they need it to pay debts. And again, maybe challenge that. Can we find the money from another source? Is it essential that they pay that debt? All of those particular elements. So again, challenge the client. The APTA has to reference workplace pension schemes. Now, in the policy statement, the FCA said that ongoing advice creates a conflict of interest, as the advisor might have a strong monetary incentive to recommend one course of action over another. And that over time, these charges can take their toll on the size of the pension fund and therefore the amount of pension income that the client can take. They say that when you are looking at this, and when an advisor is looking at this particular area, you have to show that the proposed scheme is not only as suitable as a workplace pension scheme, it has to be more suitable. So it's much more stringent. So that's what the FCA is saying. It's saying that in their view, consumers would not benefit from ongoing advice, as their circumstances are unlikely to change significantly from year to year, and they're better off maybe being in the default workplace pension scheme. So you have to address this particular issue within your suitability report. Now, this applies to all advisors. It doesn't matter how the advisor works. It includes panels, vertically integrated firms. It doesn't matter. Everyone has to compare this. You can have a look at the most recent workplace pension scheme, but if there are previous ones which you could accept a transfer, then the FCA says maybe look at those if they're more relevant. By more relevant, they mean lower charged. In the app to bring out the advantages and disadvantages of doing this, having a look at maybe the areas of, do your clients need a complex range of funds? Do they need, given that their risk profile or their knowledge or their experience, what are their product charges, and make sure the product charges are compared with the workplace pension scheme, and also whether ongoing advice is actually needed for that particular person. Now, the FCA wants you to consider this even if the workplace pension scheme doesn't facilitate advisor charging. They say that if that's the case, well, you can pay the fees outside the product. If the client can't afford the fees outside the product, then maybe consider if the risks can be addressed in a different way. For example, a blended annuity and drawdown, or a partial drawdown, or no transfer at all. Now, in practice, the workplace pension scheme is going to be, for a particular type of customer, it's going to be better suited. And this is where, again, the information you gather is going to be able to evidence why a wider range of funds or ongoing advice is going to be needed for your client, and is going to be what your client needs to help them achieve their objectives. It's also worth remembering that in practice, many people transfer at the point of retirement. They might not have a current active workplace pension scheme. The final area I want to have a look at is suitability. Now, the FCA asks that you demonstrate suitability, and to do that, you need the complete evidence to make personal recommendation. And I know I have repeated that phrase several times today, but to go back to that, you do need to have all the information on file, detailed, in depth, recorded, and that is your evidence for the personal recommendation. You have to demonstrate why it is in the client's best interests. If you don't have all this evidence, you can't make the suitability. You can't say whether it's suitable. You cannot make a personal recommendation. And you need to show why the defined benefit scheme cannot meet the client's needs and objectives. So again, this is an example I've pulled out of the guidance, and it's an example of poor practice of demonstrating suitability. So here, the client said that the person wanted to transfer for flexibility. I think we used to see this quite often for flexibility or for higher death benefits, but for no explanation around that to substantiate it or to give the evidence to back it. So this example, they didn't ask any further questions about this objective or what it actually meant to the client. And you can read the example for yourself. So what the FCA is saying is don't use that. Use evidence, make it personal, and make sure that you keep really good records on why these things are, why you have made your recommendation. Don't just use cut and paste phrases. You also have to make sure that the client understands the risks. And that could be part of asking the client to, there are a couple of ways around doing this. The FCA says that actually a tick box at the end of it, do you understand the risks? Yes, no. Ticking yes may not actually satisfy the FCA. There was an example in the guidance of a firm that when they asked the client to put down the risks in their own words and to say what would they do if the stock market crashed in the first few years? What would they do if they lived beyond 97? That sort of thing. So trying to show that the client understands the risks in a much more meaningful manner. I go through the suitability report. It has to be a one-page summary and it has to have 4 different areas. The first one is you've got to look at the first year charges in pounds and pence. You have to compare that to the defined benefit charges, the monthly income, but you also, as I said before, need to work in the workplace pensions as well and to include a comparison to that. When you look at the transfer advice costs, you've got to be very upfront about what that is going to be, but also how many months of DB income would it take to pay for that? So that's almost bringing it back to the client saying, well, what does this actually mean for you? You've got to include a bit about pension transfer risk warning and saying what are the risks associated with this. And as I said before, make sure that the client understands these and but maybe not using a tick box, maybe trying to find a different way of getting clients and to show their understanding. You've got to put down fully what your personal recommendation is, what section of the report says the reasons why, because this is just a one-page summary, so you can't say exactly why, maybe in full detail on this page. And you've got to get the client to sign to say that they intend to follow the transfer advice. And the fourth part of this, just a one-page summary, has to cover the ongoing management advice. Information about the ongoing services, the cost of it, the cash cost of it as well, not just percentage. The fact the client can cancel at any time, that they're not required to take this. And again, the client has to sign this particular bit. So the one-page summary is quite tight, but it's a very important part of your personal recommendation and of the suitability report. This is what the FCA expects it to look like. This might be a little bit small writing, but I'm sure you get the essence of this. It's comparing the level of income across the 3 different places, in whether they stay within the defined benefit scheme, they transfer to a workplace pension, or they transfer to another DC pension. This one says that the pension transfer advice is going to cost £6,000, which is equivalent to 7 months' income from my current scheme. This to put it into perspective. They're asking the client to sign to say they understand the pension transfer risk warnings. They are saying that they want them to also sign to understand what the advisor's recommendation is, and they say where the reasons for that recommendation are, because as I've said, you can't include all of that on a one-page summary. There's also another signature required for the ongoing pension management advice and where that pension management, how much that is going to be, and the fact that they can cancel. So that gives you an indication of what a one-page summary could look like. So I hope you found this interesting, and I really hope you found this useful. There's a lot to take on board when you're reviewing or developing your processes within this area, but it is well worth the time just to take a step back and to look at this. And it's maybe not looking at it just now or a one-off. I think this is an area that really does keep evolving, and the FCA's expectations evolve as well. So it's worth keeping up to date with those and to keep on reviewing and to always have a look with fresh eyes at these particular processes. And also with your stats, your MI data on your transfers, you can use that information to change your processes as well, maybe hone them, to perfect them. And again, you will get brownie points from the FCA for doing that. So you will be showing that you are using the evidence to perfect your processes. So my key points from today's webinar are: make sure that you have complete evidence. It really needs to go deep, and it needs to go wide, and it needs to be documented. Ask open questions. Don't ask closed or very obvious questions like, do you want to retire early? Use all the evidence in the APTA, but make it personal. Don't do cut and paste paragraphs. Make sure that you're looking at each client individually and afresh. The workplace pension scheme has to be taken account of. You have to show why the alternative is more suitable. So again, looking at what these alternatives are. Keep excellent records, and as I was saying, just keep on reviewing and keep challenging maybe your own processes in this area, because you might be able to develop them further. Thank you very much for your time. Now, if you do have any questions, then please get in touch. Thank you.